The House Financial Services Committee held its first hearing on a draft bill to crack down on the unregulated energy derivatives markets, and the committee immediately split roughly on party lines over whether the new draft is too much or too little. Our executive editor, Margaret Ryan, is here now with more. Margaret.
Susan, the 187-page bill was written by committee chairman Barney Frank, and he calls it a discussion draft. He admitted up front it has gaps and needs some changing, but with the worldwide derivatives market in energy, finance, and agriculture nearing $600 trillion in value, he thinks regulation's time has come. Frank says it's important to preserve the legitimate business of risk management, but shut the door on the abuses that led to last year's financial collapse. Now, he got general endorsement from CFTC Chairman Gary Gensler and other witnesses. Gensler says as much trading as possible should be pushed into regulated venues, exchanges, and clearinghouses. Most derivatives are now cleared by the same financial giants that failed or needed bailouts last year, he says, and clearing should be separated from those banks. And he wants trading subject to strict capital and margin requirements. Some Republicans said the draft, while better than the Obama administration's August proposal, may go too far and just expand bureaucratic regulation. Several questioned whether regulators just need to enforce the rules they have. But some Democrats said the bill doesn't go far enough. That proposed exemption will let wily traders continue to escape regulation. And Frank says he intends to get the bill marked up and out of committee in November.
So, Margaret, this bill would affect more than just energy commodities.
Absolutely. We're talking about the infamous credit default swaps. We're talking about agriculture, currency derivatives, mortgage derivatives, the whole shebang. You'll recall that back in 2000, there was a bill passed. Phil Gramm of Texas was very instrumental in this one. It exempted what was then an infant market in derivatives from regulation. And it assumed, the assumption built in was that the large entities involved, these big banks, would track their own risks, they'd control it, and derivatives originally were aimed at controlling risks. It was only as the years went on that traders figured ways to place bets on bets, and it actually got riskier. And the whole market exploded in size. And last year, as you know, it was part of that complex of interwoven bets on bets that helped bring some financial giants to their knees. And so nowadays, you looked at it, the giant banks simply didn't know their odds, and you have people saying now we do have to regulate them.
Now, why is Gensler so insistent on moving all this trading to these exchanges?
Well, I think part of it is simply to regulate them. A lot of OTC packages now in derivatives are sold. They may be sold over the phone. They're individually tailored. They're not in a venue where it's very easy for a regulator to get a grasp on it. Now, if you put it onto an exchange or put it through a clearinghouse, then you have a record. That's the first thing. You can make it much more transparent, and the regulators and the exchanges and the clearinghouses can aggregate this data. Gensler argues this is really going to benefit end users because instead of having no idea what their broker is, what price their broker is quoting to somebody else or another firm is quoting, you'll be able to see it just like you can with a NYMEX or the NYSE. You see aggregate data, not an individual trade. And the exchanges or clearinghouses, they are businesses, and so they have to insist that their members have a certain level of capitalization and that they post margin so that they can settle up every day. Now, Gensler wants to see those margin requirements actually incorporated into a rule, if not into a statute, because over the last few years, when times were good, we saw banks erode those capital requirements for favored customers, and that really hurt them last year. And the other big point is these institutions clear daily. That means you have to add up where you are on either side of the balance sheet. You have to come up with the capital to make the difference if you're in the hole. And basically, if you have to do this every day, you can't just get into a hole and keep digging for months and months, which is apparently what happened in the past.
Okay, but now some in Congress say that this all goes too far.
Absolutely. Republicans in particular in the committee were arguing that it's just expanding government needlessly. It had just cost money. It was taking the wrong approach. A number of them said it would drive legitimate businesses out of the market. There were a lot of claims that it would cost the economy jobs. It would harm the recovery. Not arguments, frankly, we heard at this time last year, but they were fairly consistent. Jeb Hensarling from Texas, for instance, said, "Look, AIG may may be a culprit, but not the energy industry. It wasn't the energy derivatives that were at fault. Frank Lucas of Oklahoma said the CFTC and the SEC, there was an SEC witness there too, he said, you guys have the authority to crack down on the abuses now, and why aren't you? You know, his implications of how they weren't doing their job. Barney Frank said he'd put in some exemptions trying to, you know, strike the right balance, given objections from the industry that he had heard, to accommodate them. And then a number of Democrats, including Gensler, raised some of those exemptions and say, wait a minute, this will just let the very people we want to regulate get out from under regulation. So if there was anything that came out of this hearing, it was that it's extremely complex to apply this kind of regulation to the real world. It is clear, I think, that some kind of bill is going to come out, and the derivatives industry is in there trying to limit the damage.
Oh, okay. Margaret Ryan, thank you.